Good day, everyone. Welcome to the weekly note of GTC Traders. This is a feature we do each week, as you can tell if you click on the little category for the GTC weekly note. This is something that we do each week. If you are new, I am the senior partner of a separate private proprietary firm, and we decided, hey, how about we put our weekly note up? We're not by any means the only one that does a weekly note. This is something that's very common among many firms, weekly note or a daily note. And we thought, hey, how about we just make this real easy on ourselves? How about we just copy and paste sort of our weekly note from our private proprietary firm and put it over here on GTC Traders. So that is what we do. And the article itself has all of the vagaries usually of different thoughts as far as the economic calendar for that week and what we see in interest rates and various markets. If you're sort of curious about a weekly note, if you go to the GTC Traders YouTube page and you look at something like the playlists, so you click over at the playlists, come down here, go to the GTC weekly and daily note playlist, look at the full playlist. The first three, maybe even the first four videos really describe why so many firms do this. Okay, so why so many firms have a weekly and a daily note, really what is the value of a weekly and daily note, what it is and what it is not. So that's just for folks who are new. And then as I will now, I usually yabber on about the vagaries of each week. Good day, everyone. Today is February the 5th, 2024, sort of my thoughts around the weekly note and just what's going on this particular week of February the 5th, 2024. I've been watching oil, a rally in oil. It wouldn't surprise me after we've had this rotation down. We've had a lot of news and oil dumped lower. So a rally wouldn't surprise me after all of this news as the market begins to look forward and price in, all that data is being priced in. And as well, I really wouldn't mind it. I'll just say it that way. Really wouldn't mind a rally in oil as I look over at USO here. And I'm also looking at my other monitor. Where are we at? Yeah, we've started to rally a bit as I look at the DOM. So I'm not going to complain. Regardless, I have plenty of time for that. And speaking of oil and related markets, for those of you who are new or aspiring traders, oil and interest rates they definitely dance a dance, right? Especially when you look at the forward curve on oil. And speaking of interest rates, what did I say last week? I think of that line from Independence Day, right? I've been saying it. I've been saying it for so many years. Regardless, no, this is something that I had mentioned last week, that a sell-off, and I was looking at this more as a tell, not a trade. I was looking at it as more of a tell. I wanted to see what the March 2025 SOFR contract was going to do, and we headed lower to higher interest rates. I said a sell-off. What did I say? I said a sell-off there wouldn't surprise me. We went down to that, 96.28, 96.29 structure, and then sailed right below it. Just nice, clean sell-off to higher interest rates. And again, that follows my thoughts that I did have last week, that I don't understand everyone's insistence on, we have to cut the rate right away. No, we don't. Listen, anybody that's known me for years, more and more people are saying, hey, he's back, right? I'm noticing that on the official GTC Traders channel. Don't forget that is there if you're watching this on the older channel, because we're putting those videos up there as well. But I'm noticing more and more people, sort of like, hey, he's back. So, yes, regardless of any of that, you folks know when it's time to be critical of the Fed, I am critical of the Fed. But I don't beat that drum for views or to get, our content viewed in any greater manner. You know what I mean? People do that, right? It's like, hey, I'm going to get the I hate the Fed drum out and beat it. And it just sort of raises this populist angst and they get views for it. Whatever. That's not me. I've always sort of gone by the punchline and the tagline: reason, rationality, balance. What's logical, what's real, what's based in reality, not emotion. So I've been critical of the Fed many times. Back during the housing crisis, I was very critical of the Fed, as many know. As many are seeing, hey, he's back. You'll know that I was
critical of some moves during the Great Financial Crisis and the Great Recession. I was not as critical of them during, like, I would say 2009 to the first, but I would say about 2015, maybe 2014. I was like, guys, you need to raise the rate. You need to raise the rate, right? But from like 2009 to 2014, I was like, nah, I think what they're doing is good. I think it's fine. We just avoided $120 trillion black hole singularity, and we did it with only $700 billion that eventually the taxpayer made out on. I call that a win, right? And they did it without printing they did it without printing money and putting it into the hot economy. Yes, they printed money, but it was ex nihilo, but it was ex nihilo that just basically worked as a volatility buffer. And I was like, I call that a cheap price for avoiding $120 trillion black hole singularity of financial destruction. I call that, it's like pretty cheap, right? But around 2014, again, I went critical of the Fed. It's like, nope, they need to raise the rate much higher. We're getting into problems of asset bubbles, which I'm going to speak about more this month. We're developing a problem here, right? And up until they raised the first interest rate after ZIRP, I was like, what's that line from Jurassic Park? Must go faster, must go faster, must go faster. That was me, right? My whole point in saying all of this, and especially during 2020, I was very critical of the Fed. My whole point in saying this is, like, I don't bang a drum for content views and likes and clicks, because I think it's going to get likes and clicks. Reason, rationality, balance. What's reality, right? What's reality? And when the Fed makes a right move, I don't care who doesn't like it. I'll say, no, I think that's the right move. When they had that pause on interest rate hikes, right? I think they did one more after that. I was like, nah, I think that's pretty smart. I think that's pretty smart. This last, I watched the press conference. I watched everything, and I was like, nah, I sort of agree. Because here's the thing, right? And I've said, interest rates can normalize. Let me qualify that statement. Interest rates can normalize if inflation stabilizes, but it just remains hovering. Let's say it remains hovering at like 2.8%, 2.9%. It gets sticky. A little more structural inflation comes into play as vertical integration takes over in manufacturing in the United States. I think that's what the Fed's concerned about, and I think that's an intelligent concern. So I agree with him. And very obviously, if inflation got too low, 1.9, 1.8, 1.7, right, then, okay, yeah, maybe you can see it cutting the rate. But we have to see if inflation can stabilize or become sticky, and they need more data for that. I need more data for that to really get a firm handle on inflation. It's not just like, hey, look, there's a print number, let's just flip the switch. And I don't understand people, because they just seem to have this, like, cut the rate Tourette's lately. As I said, I agree with the Fed's recent statements. Collect more data, find out. And as I said, sell off in the 3-month SOFR wouldn't surprise me as it heads to interest rates, as the market's got to reprice that. And here we are. And I got to tell you, I really don't understand this cut the rate Tourette's that some seem to have, like cut the rate, cut the rate, cut the rate. The markets seem to be doing fine. So I don't understand this Tourette's one seem to have with cut the interest rate. I mean, to hear some people talk, it's like, no, we got to cut it, we got to cut it, we got to cut it at all-time highs in the market? Really? I mean, in one way, have they sort of backed themselves into a corner of creating a worse bubble than I think may already be starting and be in its beginning stages in asset prices. I mean, housing has sort of froze up like an ice block, but I don't think that's necessarily a bad thing. The area I'm in, houses were being sold sight unseen. They were just literally hitting the offer and then getting in a competition with hitting the offer. Just bam, 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 sight unseen. So, and we're going to immediately, just after that happened, and the housing market's cooled down a bit and sort of frozen up a little. Frozen up, I think, would be the better description. Just cut the rate, cut the rate, cut the rate, cut the rate. It's like, really? My whole point is, when I talk about the normalization of interest rates, I'm saying if inflation becomes sticky, stays, with core above 2%, then interest rates can normalize. And again, I've got my eye on, I think global supply chains is a very simplistic way to say it, but I think you have to be thinking about the return of manufacturing in the United States and more, and even if it's not manufacturing, vertical integration in the United States, which is going to basically keep inflation higher, and that's a great thing. There's a difference between just inflation, productive inflation, asset bubbles, right? You have to differentiate when you're talking about inflation. I've just never understood this. All inflation equals bad. No, it doesn't. Where'd you get that idea? I saw this the other day. It was someone who had put up a chart of something from like 1929 and how much, if there wasn't the money that we have in the system now, asset prices wouldn't have risen as much. And therefore, this is all the Fed's fault for printing money. And it's like, wow, you're really going to go to that correlation? Like, seriously? Like, yeah, back in 1929, nobody had a car either. Who keeps money for 100 years? Nobody. All inflation is not bad. It can mean companies are thriving and doing well, as is the consumer. Back in 1929, they didn't have supersonic jets. They didn't have cell phones. They didn't have Nike shoes and everything else that we've got today. They didn't have space probes the size of a piano going, 36,400 miles an hour, going out to the furthest planetoid in the system and taking HD pictures and sending it back. We weren't getting data from interstellar space, right? It's like, come on, man. The economy has expanded. You need to represent that. So anyways, now I'm getting a little off track. Regardless, the long Dan way of saying, pretty much I agree with everything they said. Let's get a little more data and see what's happening with inflation over the next few months. I think that's a smart decision, right? And we can leave it there. And hopefully we get a little more of a rally in oil prices. And that has been what it's always been. Oh, and something I'm going to talk about a little bit more is asset bubbles, because that's been on my mind as late. Again, another reason why I think we don't need to be jumping to this cut the interest rate Tourette's, right? I think ones can just sort of maybe put a little bit of a pause on that, because something that's been on my mind lately is asset bubbles. And how do you trade those? So that's a question we are going to have in the next entry. Actually, I already recorded that, and I've got to get that out. But for now, that has been what it's always been. It's simply been our thoughts, not yours, for whatever that date is. As always, stay safe, trade well, and remember that love doesn't cost a dime.